Hi everybody, this is Ms. Morgan and I want to go over the lesson about calculating depreciation. The first thing you'll see up here in the top left is the journal entry to record the purchase of a truck. You would debit your delivery truck account and you would credit cash for $100,000, and here's a picture of the truck. When that happens, you have a truck, which is an asset worth $100,000 in your books. And then you would credit cash, of course, to pay for that, or accounts payable when you pay for that. But when you account for everything at the end of the year, when you create your financial statements, this truck goes on the balance sheet. And it's not a current asset because it's not inventory. It's actually going to go under the category of the long-lived assets, the long-term assets, under property, plant, and equipment. And you would just list your truck at a value of $100,000. The problem with that is that even though assets make you look good, you own things, so the bank knows that you have some net worth. But in reality, owning a truck, especially a delivery truck, is part of the cost of doing business. And if you remember from the first 2 weeks of school, I wrote up on the board the definition of assets, liabilities, owner's equity, revenues, and expenses. And the definition I use for expenses is the cost of doing business. Well, most of you would agree that owning a delivery truck and paying for that truck would be a cost of doing business, especially if you have to deliver goods to your customers. But it doesn't get counted as an expense. As you see here, the truck shows up on the balance sheet as an asset. If you remember, in chapters 1 and 2, we talked about the supply account. When you purchase supplies, we put those supplies in a supply closet, and as long as those supplies stayed in the closet, they were assets. But when they were used up, we could call it an expense. And so that's what we're going to do here with depreciation. Now, the accounting definition of depreciation is the decline in usefulness of a fixed asset. And so what we're going to do is we're going to record depreciation. Now, if you remember from the previous chapter on adjusting entries, you'll remember that the adjusting entry for depreciation is a debit to depreciation expense and a credit to accumulated depreciation, and then dash whatever asset it was that was depreciated, and that would be for a certain amount. Here, I'll just put a question mark here. And in previous chapters, that amount was given to us. And then depreciation expense would be the cost of using that truck for a particular year. That would be the adjusting entry. And then it would get to the income statement a partial cost of using that truck. And then the accumulated depreciation for that truck is going to go here. And so that's how we can expense the cost of running our fixed asset. It's expensing the cost of using up that fixed asset. So now we're going to look at 3 different ways to calculate depreciation. Straight line is what we're going to look at first. Then we'll look at units of output. And then we'll look at double declining balance. Now, there's some other methods out there, but these are the 3 that our chapter is going to teach. The first method of depreciation we're going to look at is the straight line method. More companies use the straight line method because it is easier to use and it's GAAP approved. You'll see here that the salvage value of this truck is $10,000. That means that at the end of its useful life, it still should be worth $10,000. So we could sell it and maybe have a gain or loss on that sale. The useful life of the truck is 10 years or 200,000 miles. And so we're going to figure out depreciation using the straight line method. The first thing we'll have to figure out is the depreciable cost. The depreciable cost, and I typed it right here, is a $100,000 cost minus the $10,000 residual value or salvage value. So $100,000 minus $10,000 is $90,000, which is the depreciable cost of that truck. You'll divide that by the number of years to come up with your depreciation amount. So I'll say equals this divided by 10, up as a percentage, $9,000. Now to come up with the straight line rate, you will take the number 1, and let me put an equal there, 1 divided by the number of years, so 1 divided by 10 is 10%, which is your straight line rate. You'll actually need the straight line rate for another method. So the depreciation for straight line method is $9,000. So on the adjusting entry for depreciation expense, you'll debit depreciation expense for $9,000 and you'll credit accumulated depreciation for $9,000. You'll debit depreciation expense, $9,000, and you'll credit accumulated depreciation for $9,000. On your financial statements, in the balance sheet, under your property, plant, and equipment, you'll list your truck for $100,000, then you'll say less your accumulated depreciation, which is $9,000. You'll take the difference between those two, and that's going to give you the book value of the truck, which would be $91,000. On the income statement, when you list out your expenses, depreciation expense will be listed at $9,000, and that is how you would expense the cost of the truck over the next 10 years. The adjusting entry for year 2 will look exactly like the adjusting entry for year 1. That's because we're using straight line and the depreciation amount is the same for every year. Once again, at the end of the year, depreciation expense will be wiped out, and then after the adjusting entry, we will post a credit to accumulated depreciation for $9,000 and a debit to depreciation expense for $9,000. Then when we look at our financial statements, the expenses, depreciation expense, will be listed at $9,000 again. And now accumulated depreciation will be $18,000, which means that now the book value of this asset will be $100,000 minus $18,000, which would give us $82,000 book value for that truck, and on and on and on. So at the end of 10 years, the balance in the accumulated depreciation account, if we're talking about 10 years later, the balance would be $90,000. And so if the balance to accumulated depreciation is $90,000, that means that the book value of that truck at the end of 10 years would be $10,000, which is equal to the salvage value. So that's how depreciation will work. To calculate depreciation using the units of output method, the first thing you'll do is calculate the depreciable value, just like we did before. You'll take the cost of the truck, $100,000, minus the salvage value of $10,000 to get the depreciable value of $90,000. The units of output, however, will not be years for the units of output method. You'll see here when we talk about the truck, the useful life is 10 years, but it's also written as 200,000 miles. So here the units of output will be miles. So the truck is going to be good for 200,000 miles, which means to figure out the depreciation rate, you'll say $90,000 divided by 200,000 miles is 45 cents per mile. So to figure out depreciation this year, because it's based on miles, you have to know how many miles you drove the truck this year. So the way you figure out depreciation is 25,000 miles were driven this year times a depreciation rate of 45 cents per mile. Your depreciation for this year will be 11,250. So then your adjusting entry will look like this: 11,250, and the accumulated depreciation for year one would be 11,250, and depreciation expense would be 11,250. On the income statement, depreciation expense will be 11,250. Accumulated depreciation will be 11,250, and the book value of the truck would then be 100,000 minus 11,250 is 88,750. Every year your depreciation will be different because it's going to be based on the miles driven, and that is called the units of output method. The last method of calculating depreciation is called the double declining balance method. The first step is to find your straight line rate, which you already know how to do. It's going to be 1 divided by number of years. Step number 2 is to double that rate. Step number 3 is you're going to multiply the book value of the asset times the doubled rate, DDB, double declining balance rate, for every year. And so let's go through those steps very quickly. First of all, the useful life of this asset is 10 years. And so to find the straight line rate, you'll just say 1 divided by 10 is 10%. Make that into a percent. And then when you double it, that's 20%. So here in the chart, you're going to use 20% all the way down. Every year, you'll multiply the book value by 20%, because that is the double declining balance rate. Step number 3, to find depreciation, you'll multiply the double declining balance rate by the book value, BV, every year. So the book value of the truck at the beginning of the year is $24,000. So the book value at the beginning of the year, the first year, before it has depreciated at all, is $100,000. Then you'll take out depreciation of $20,000, and that gives you the book value at the end of the year of $80,000. If your book value at the end of year one is $80,000, then the book value is $80,000 at the end of year 2. And so that's how you would do the chart for double declining balance. And you see here that your actual depreciation amounts are here in this column, and that they are steadily declining, which is why it's called double declining balance, because you depreciate the asset more in the first year, and then less in the second year, less in the third year, etc., etc.